Good morning, good morning, good morning, ladies and gentlemen. This is the Pill Method House here on Clubhouse. We're also simulcasting to YouTube, Facebook, Twitter, and LinkedIn all at the same time, giving out this information. I'm Don Daniel, founder of Pill Method International, and we are talking about, handling your money, handling your debt a better way, paying off your loans in the most efficient way possible. Folks, this is the most powerful debt reduction, wealth building, money management system on the planet by far. We save you more money than anybody else, and then take the savings and then show you how to implement a saving strategy so that you can turn those interest savings into generational wealth for you and your family. Listen, this is an awesome, awesome system. And we are here promoting it because not only do we have a cloud-based AI system, a computing system that does all of the math, that guides you like financial GPS. Not only that, but we have the best financial education by far. What do I mean? When it comes to understanding how banks make their money, they make a lot of it because they use a formula that turns a 3% loan into paying them back 51% of what you've borrowed. What? Yeah. If you borrow $200,000 at 3% for 30 years, guess what? Here's what the bank wants: $103,000 in interest. How is that 3%? How is that 3%? Listen. Oh, wow. I see somebody in here says, I am so pleased to see you again. Wow. Listen, man, listen, we need to get together. We need to get it. All right. Let me put my card in the chat. ICE 10K.com. All right. There you go. And listen, I don't know you by this name because obviously we know each other. But if you want to type your actual name in there, so I can. Oh, you met me in Jamaica. That's right. That's right. All right. So yeah, we went to Jamaica a little while ago. When we went to Jamaica, we actually had Patricia and I put on a seminar at a hotel there in Jamaica, invited a lot of people in. We didn't charge for it. And listen, oh, there it is, Oral Lawson. That's right. That's right. I remember you now. I remember you now. So listen, man, let's get together. I've just put my 10K card in there. That's my digital business card. Let's get together and talk. All right, listen, somebody's on my stage. Who's on my stage? What's going on with you, young lady?
Good morning.
Listen, go ahead and tell us who you are and what brings you up this morning.
Well, my name is Aniete Odua, and I have no idea how I got on the stage with you. I just accepted the invite and here I popped in, but I'm a realtor here in the Houston area, and I am one of your biggest fans, and I'm just here to hear what you got to say regarding this title up here. Everything you have to say, I definitely do treasure it. So good morning, everyone.
Well, listen, thank you very much for being on the stage. And anytime you want to tap in with a comment or with a question, please do. But I'm just glad you're here. And one of the reasons why is because all of your followers have just been notified that you're on this stage, and they may follow to see what I have to say as well. And so anybody in the audience, you don't have to say a word. I would love it if everybody in the audience would just come to the stage. Listen, if you want to listen from the stage. And if you have a question, then you can jump right in. But if you don't want to say anything, you don't have to. Just raise your hand. I see you, Giovanni. I see you, Giovanni. Why don't you come to the stage? There she comes. There she is. All right. Excellent. Excellent. Come on up. All right, Giovanni. How are you doing this morning?
I'm doing well. How are you?
Excellent. Excellent. So did you want to just be on the stage? Did you have a question? Did you have a comment? What was it?
I actually saw a Instagram video about this yesterday, and the friend who sent it to me said, I don't know if this is true or not, but you might want to check this out. So I love you. I've been following you since I met 10K a couple of years ago. And I'm definitely going to hit you up when I'm ready to purchase. But I like Anita, I just wanted to hear what you had to say about this as well.
Well, listen, what you want to do is hit us up just prior to purchasing, and getting the right loan in the right way is half the battle. So there are a lot of choices out there. We're going to help you to filter through those choices so that you get the best loan for you. And most times is what some of the experts are saying actually the worst loan. What? Yes. They'll tell you it's the worst loan. I'll give you listen, I'll go to spill the tea on this. I'm going to give you the numbers. When you want to compare these loan products, I'll give you the numbers so that you can choose based on real facts, real numbers. So you can say, oh, yeah, this is the one. It doesn't look like it, but it actually is. Thank you very much for being on the stage. Listen, don't let them be by themselves. Come on up to the stage. Keep them company. You don't have to say a word. Now I'm going to ask you, but if you don't answer, I'll think that you're at work. You just want to be on the stage to help us out to grow the room. So anybody else in the audience on Clubhouse, come up to the stage right now. It will help us to grow the room. Raise your hand and come on up. If you have a red ticket on your profile, guess what that means? That means you're not a member of this house. So go up to the top on Clubhouse and click where it says the P.I.L.L method. All right, click that and come on up. All right. And then when you click that, you can join the P.I.L.L method house. And anytime we're open, or anytime we even post that we're going to have a room, you'll be notified and you can RSVP. All right. It's going to be so good. So go ahead, join and follow me as the moderator so that anytime I'm in anybody else's room, you will get notified and come in and hear what we have to say. And ladies, thank you so very much for the compliment and for what for what you said about the information. So we got more information for you today. So I'm going to put some things up on, let me see, from the news on this thing. And here's one of the things is Biden's raising mortgage payments for people with good credit. That's one thing. And from CBS News. All right. Well, listen, let me put this on the screen. Let's slide this over. All right. We're going to take a look at this. This is from the news. I'm not making this up. So we're going to put that on the screen right now so people can see. There we go. All right. Is Biden raising mortgage payments for people with good credit? Okay. Now that's kind of misleading. All right. How about this from CBS News? Mortgage fee structure 2023. How's it changing? All right. Good credit home buyers soon facing penalties as bad credit receives benefits. Look at that. Okay. Biden mortgage law, higher mortgage fees for borrowers with good credit. Inside, let's take a look at this one. This is from ABC Chicago, and we're going to break some of this down. Let's see what it has to say. All right. One of the things that it's talking about. Let's get this off the screen. That's distracting. Why is this happening? All right. So this is an FHA program. Okay. And so what is happening? Go ahead.
Excuse me. Where is your screen? Where can we watch this? Or?
All right. That is so. I am so sorry. If you're on Clubhouse and you want to see what we're doing, go to a separate device. Like if you have a separate phone, a laptop, or a tablet or something, you can go to YouTube, search for P.I.L.L method, and you can watch what we're putting on the screen. Just click on the live and you'll be able to see it. So if you're in Clubhouse and you want to see what we're talking about, if you weren't here in that day, I would have gone by this and not told people. So that's why you're here today.
I was going to ask you to, oh, sorry. I was going to ask you to pin the link to the top of the room because I didn't know either. So thank you for that.
Yeah, and I thought I didn't update my app or something.
Yes. So yeah, because listen, we're live right now on on YouTube. We're live on Facebook. We're live on Twitter, and we're live on LinkedIn right now. The video, and so you just go to any one of those and search Pill Method, and then you'll see our live. Okay. So you will see our live on there. All right. Now, so that's going to be the easiest way to do it, because the link that I put up is this one, because we're going to let's see, pin this link. All right. This is my 10K card, ICE 10K.com. All right. Now, and if you go there, now, if you go to my digital business card, which you can see there, you can see how to watch us live. There's a link on my digital business card, and you can get it that way. Or you can just go straight to YouTube, search Pill Method, which is going to be faster, and then you'll find our live and just click on it. All right. So
I just posted it on the side chat for you.
Thank you so much. See, listen, I appreciate the help. Anybody else that wants to see what's going on, just go to YouTube or Facebook or whatever, and you can watch and see what's happening. So, hey, Lawson from Jamaica. Are you still in Jamaica, or have you come to the United States? What's going on? Where are you in the world? All right. And listen, I got a picture of us together somewhere, and if I can find it, I'll post it. All right. So anyway, all right. So let's take a look and see what this has. What impact does it have? Home buyers who put down a larger payment, 15 to 20%, could see a bigger increase in mortgage fees. Can you believe that? Now, here's the thing. They're looking at people who may not have a lot of money to put down. All right. And they're going to give them smaller fees. All right. But here's the thing. If you put down listen, you're in a position where you could put down a larger down payment, but they want you to pay more of a fee to be able to do that. And then they'll say, if you don't put down the larger amount so that you can avoid the fee, then you put yourself in danger of paying PMI, or private mortgage insurance. So listen, it's kind of if you look at it this way, it's going to be a catch-22. Let's see what else it says here. How will it work? The new fees are slightly more expensive for some borrowers with good credit, and slightly less expensive for some borrowers with less than perfect credit. Now, if you look at it only their way, you could get confused based on this, but there's more than one way to look at this situation. All right. Listen, Khalil Rashid says, I am on it, Ice. Thank you for sharing. All right. Excellent. I see you there watching us on Facebook. All right. If you're on Facebook, listen, immediately share this with your friends. Share it with your friends, because we're going to give you the truth about some of this. I'm actually going to put some information on the screen that's going to help you to make a decision on this. Can people who have a larger down payment, right? I'm going to show you how you can use that money not only to avoid the higher fees, but cut years off your mortgage. What? Yes. They're not talking about that. That 15 to 20%. I'm going to show you how to use that money in such a way that you can avoid the higher fees and cut years off your mortgage. Now, and one thing that I read yesterday, they gave an example of a $400,000 mortgage. Let's see what this goes on to say. For example, on May 1st, a buyer with good credit score of 750 who puts 25% on a $400,000 mortgage. That's $100,000. Okay, that's $100,000. Home would now pay 0.375% in fees on a 30-year loan, or $1,125, compared to 0.250 or $750. Listen, folks, are you seeing this? I want you to see these numbers, and I want you to listen to these numbers. If you're listening on Clubhouse, then I'm going to tell you. If you want to see what we're putting on the screen, go to YouTube. Oh, by the way, would you please subscribe? Because we're growing. We want to grow our viewership. All right, go ahead and subscribe, like the videos, and comment on the videos. Now, they're focusing on this. Whether I'm going to pay, if I put $100,000 down on a $400,000 loan, I'm going to quibble about the fact that it's going to cost me $1,125 to do it, or whether I want to pay $750. Listen, that's no money when you're talking about a $400,000 mortgage right now, somewhere between 6 and 7%. Okay, this is a distraction. This is not helpful. All right, and here's somebody else that's watching us on YouTube saying, "This is great information. Thank you." All right,
That was me.
That was you. All right, thank you.
Yeah, that's my my company.
Listen, you have a company and you haven't told us about it. Listen, I'm going to stop right now. You tell us a little bit about your company, and then I'll jump back into this.
Don't do that. This is such good information.
Okay. All right. We'll come back to that. Now, watch this, folks. Watch this. All right. Now, so we're looking at, meanwhile, a buyer with a credit score of 650 putting 25% down on a $400,000 home would pay 1.5% on the fees. All right. Or 450,000, that compares to 2.75%, or 8,250 under the previous rules. Now, even this for $4,500 as opposed to 8,250. Okay, so you're going to pay about almost half, all right, in fees if you have a lower credit score and you put down. So are people with higher credit scores actually being penalized? Well, let me tell you something. For Giovanni and Yete, listen, if you have the money to put down, all right, if you want, so here's what they're talking about. You could put the money down and pay a higher fee, or would you be interested on another way to use this $100,000 so you don't have to worry about the fees at all? Anybody?
I want the other way.
You want
to, give it to me.
The other way.
You want to see something that they're not talking about? Okay, because this is talking about a down payment, and then we're thinking, if I have a $400,000 loan, all right, and I could put down $100,000 on a 30-year loan, then I'm going to save money in interest. All right. Can I show you all of the numbers? Can I show you all of the numbers that we're talking about?
Yes, please.
All right. So here's what we're talking about. And because it's up on YouTube, you can watch it over and over and over again. So we're going to open up a new tab. We're going to put in amortization schedule. And I'm using, this is a teaching tool for us. It's Brett Whistle, BRETWHISS as in Sam, S as in Sam, EL, BrettWhistle.net. I'm using his amortization calculator. This is not part of my business. I just use this as a teaching tool. So we're going to put in a $400,000 loan, right? We're going to leave it at 6% because If you're lucky, you can get a 6% loan at this point. All right. And we're going to calculate that. That's our payment. All right. So now they're saying if you put down a large down payment, you can end up putting, if you have good credit, paying higher fees. So let's put up another one. Okay. We're going to duplicate this tab. And if I put $300,000 in, all right, my payment is different. And we're going to look at this. We're going to look at this. So let's put our calculator. I'm going to put a calculator on the screen. All right. So my payment on the $400,000 loan, is $2398.2. All right. My payment on the $300,000 loan for 30 years. Okay. So I'm going to subtract that is $1,798.65 equals $599. So if I put my $100,000 down, okay, and I have to pay a higher fee, but my mortgage payment is $599 cheaper, would that inspire me, because my payment is $599 cheaper, would that inspire me to put the larger amount down? What do you think? What do you ladies think?
I'd be inspired.
Yes.
But then I don't know anything, do I?
Well, listen, you know something, you know math, you can see this. Let me show you something else that would be inspiring. Can I show you something else? Here's the total interest cost on the loan on the $400,000 loan. Okay. So now I'm putting in my notes, we're going to save about $599. Okay. All right. Let me bring my calculator back up. Yeah. $599.55, $599.55. Now we're taking a look at the total interest cost. So when you close on these loans, look at this. They have to tell you how much interest you're going to pay on the loan. All right. $463,352. What? But if you put your $100,000 down, now your total interest cost is $347,514. Shall we do the math on that as well? See, these are all the things that the banks are using to inspire you to do a certain thing to save money. All right. So we're going to put in the total interest cost for 30 years on if we don't put the $100,000 down on the $400,000 loan. So it's $463,352 minus, all right, here's our other loan. Okay. $347,000. Okay. Minus $347,514. There it is. Now, that means we're going to save $115,000. So if I can save $115,000 on this loan, do I care about, because I have good credit, do I care about paying a slightly more expensive fee? Do I care about that, ladies?
No, I don't.
No, you don't. No. Okay. So now we have a payment that's cheaper by almost $600. I'm going to save $115,838, but that's over a 30-year period. Okay. So you have to keep the loan for 30 years to realize these numbers. Does that make sense?
Yes.
Okay, because what they're contrasting is, here's the cost of keeping this loan for 30 years at this number. Here's the cost of keeping this loan for 30 years at this number. So if we're in the loan for fewer years, do we have to throw out all the numbers we just talked about?
No.
We don't? Because remember, you have to keep the loan for 30 years to pay $347,000. But what if you don't keep the loan for 30 years? Do you have to pay $347,000 in interest?
No.
No. So right now, I want you guys to see how we're being conditioned to keep these loans for 30 years when we really don't have to. 340.
Because there's no prepayment penalty a lot of times on these loans either.
That is correct. That is correct. But I need you to remember talking about prepayment penalties later, because we got to bring that up. I don't care about prepayment penalties. In fact, in some cases, I like them. Yeah. You probably want to put a pin in that one and ask me about that later, don't you? Why does Don?
Yes, please.
Why does Don like prepayment penalties? So we're gonna take a look at that. All right. So now, here is what I want to show you right now. Okay. If you do it the bank's way, these are the numbers you've got to take a look at, but it's hiding something from you. Okay. Now on this one, we have a $300,000 loan, and the $300,000 loan is more attractive than the $400,000 loan. Would you agree? Ladies?
Yes.
Okay.
Yes.
I'm going to show you how to get the $300,000 loan, but you're going to close on the $400,000 loan. I love this. All right, Khalil Rashid, yes, I said yes. You're going to close on the $400,000 loan, and I'm going to show you how to get the $300,000 loan. Is that possible? Can you convert a $400,000 loan into a $300,000 loan without refinancing? There is a way to do it. If you all want to see how I can do that, if you're on Clubhouse right now and you want to see how I can convert a $400,000 loan into a $300,000 loan without refinancing, put a number 9 in the chat right now. If you're online, put a number 9 in the comments. I will show you how to convert this thing without refinancing, and it won't cost you a dime. All right. Boom. Look, the 9s are coming in. The 9s are coming in. Kurt Nugent, are you seeing the 9s coming in? Listen, he's my engineer, folks. Sometimes he can talk, sometimes he can't, but he's running this whole thing behind the scenes. All right. Look at that. He's highlighting all of these. People, the realtors are coming in. The home buyers are coming in. They're saying, I want to know. All right. So we like the $300,000 loan, but how did we get there? We put $100,000 down, and if we got good credit, we're going to cost us about $8,400 to do it. Well, what if we did this? Let's go back to the $400,000 loan, and ladies, I need your help. We got the $400,000 loan. We could afford. Let's say we could afford the payment on both, because that's going to be the first question. Can you afford the payment on both? If you can afford the payment on both, then I'm going to suggest close on the $400,000 loan. Here's my question to you. If you close on the $400,000 loan, but you had $100,000 to put as a down payment, where's your $100,000 right now? Because we didn't use it. Where's your $100,000? Do you still have it?
In my purse. In
your purse. Okay. All right. You still have that $100,000. So here's my question. If you wanted a $300,000 loan, could you, with your first payment, put the $100,000 as a prepayment to this loan? Could you? Could you put it down? Could you put $100,000 with your first payment? Make your very first payment on this, and now take your $100,000 out of the bank and apply it straight to principal. Could you do that?
I'm sure they wouldn't want you to, but yes.
Good. Let me ask you this, Giovanni. Do we care what they like?
Not at all.
Watch this. So I need you to take a look at, on the $400,000, I need you to take a look at cumulative principal, because this is how much, so this is the third column. This is how much principal you pay down at any one time. You can take a look at even 1 year. You had pay this principal down by $4,900 after 1 year, and you're going to pay $23,866 in interest. Okay, that's just one way of using cumulative principal and cumulative interest. But if I have this $400,000 loan, I would make my first payment of $23.98. I would take my $100,000 out of the bank and apply it to my principal. And guess what? The very next month, let me show you where you'd be on this loan the very next month. We're going to scroll down till we see $100,000. I want you to see what happens when you do this. Oh my goodness. If you're watching it online, there is a slight delay between what I'm saying and what you're hearing. Here's the first time we see $100,000. It is on line 164 of your amortization schedule. Okay. You just knocked off 164 payments off your 30-year loan. Let's do the math on that. Okay. 164 payments, 164 divided by 12 is you knocked off over 13 and a half years off this loan. Okay. And let's take a look at, so if we're here, I need you to go over to the side here. Oh, how much do we still owe on this loan? Is this $300,000? Is this $300,000? Are we at the $300,000 mark?
299,186.
Exactly. So we still have the $300,000 loan, but are we starting on payment number one? No, because
We're halfway through.
We're practically halfway through. Now, these articles that are in the news right now, the videos they're putting up, the news articles that are put, are they talking about this? They're talking about, do you want to pay a fee of this much or that much? If you got good credit or bad credit? Listen, if you have $100,000 to put down, don't ever put it as a down payment. Use it as a prepayment. And in this case, we're knocking off 13 years off this loan. And remember, the total amount of interest saved, was like $115,000, right? But you had to keep the loan for 30 years. I need you to see how much interest you just saved in 1 month. Just in 1 month. And I've highlighted it here. I need you to read it to me and say, oh, no, listen, I got the wrong. No, that's the right line. How much interest have we saved in just 1 month? Ladies.
The highlighted says 290,990.
So in other words, if you make every single payment on this loan for 13 and a half years, you will pay $290,000 to pay this loan down to this spot. But if you give the bank the money up front, you're there instantly in 1 month, so you don't have to pay the $290,990. Is that correct?
Yes.
That's what it looks like.
Would you like to see how much interest you actually paid to get it there? Can I show you?
Please do.
Here you go. $2,000. Lord have mercy.
Say that again.
$2,000 because you're putting it with the first payment. You see, on your first payment, you're going to pay $2,000 in interest to give them the $398.20 in principal, correct?
Yes.
But if you put your $100,000 down on this same month, you don't have to pay any interest out of that $100,000, do you?
No.
No. And then you're all the way down to line 163. Let's say you got this loan and you made your first payment in January. All right. So you made your first payment in January. You're right here now in January. So your next mortgage payment for February is line 165. That's where you are in February. If you take your $100,000 and put it down, and that is $290,000 in interest you never have to pay. And they're talking about trying to save $115,000 over 30 years. We've already saved 290. Folks, where else is this information being taught? I want you to tell me. Where else?
Nowhere.
Nowhere. Let me see if I got any comments in the chat. Listen, we need to get more people in here. Start inviting some people in here so that they can see these numbers, okay? So that they can see the numbers, see what's going on, all right? All right, so now, if we're taking a look at this, all right, and we see now Sheila Coleman says, good morning. She says, wow, I'm a realtor. I'm sharing this with all my clients. Now's a good time to pause for the cause. All right. And all your realtors, if you want to share this YouTube channel with all of your people, that's number one. Share the YouTube channel with all of your people. So I have a client who had a loan similar to this a few years ago, $400,000. Okay. $400,000. And remember, if somebody does not put, they were trying to put 25% down so that they could pay less interest, they save them like $500 in their payments and $115,000 in interest over 30 years. Plus, they were going to avoid PMI. Okay. Plus, they were going to avoid PMI. In my system, if they get the $400,000 loan, are they paying PMI? Answer me that, ladies. Are they paying PMI?
No.
Well, I'm talking about on when they close. Are they paying PMI at the close?
Yes, on that first payment.
Yes.
Yes.
Oh, and then what?
And they pay a fee for having PMI.
So, and you said no, but why did you say no? Why did you say no? They have it on the first payment, but then you said no.
Well, because I kind of got confused on the larger, when you put the larger down payment, you're
right
past that 20% equity
yes.
that's required to not have the PMI.
Exactly. So in my system, they pay PMI for how many months?
Until they got to line 164?
Exactly. For how many months?
Oh,
if we we only pay PMI 1 month.
And then it falls off on some loans.
And on some loans, if it's an FHA loan, and you're only required to put 3% down, you can't get rid of the PMI. But if it's a conventional loan, and you get to
conventional, it'll automatically fall off. But if it's FHA, if you do not call them and tell them, they will let you continue to pay even after you have a 20%.
Isn't that something? Isn't that something?
I was gonna ask you. So is it not good to do FHA, or just call them, like you said, just call them and ask them after you do it this way?
And
I mean, you use all loans as a tool, but I'm saying you got to pay attention to when that 20% equity is there, because then you manually have to call in and say, hey, I have paid over 20. I mean, I'm up to the 20% mark. I'd like to, get off this PMI. Then they'll go ahead and process it. But when you're doing conventional, it will automatically drop off once you hit that 20% mark.
Listen, folks, we're learning a bunch in here today. Don't get distracted by and then caught up in the language that is going to condition us to be in debt for 30 years. And do you know, most homeowners, most home buyers because if you're still making payments, you're not a homeowner. You're a home buyer. Most home buyers who have a 30-year loan will never pay off their mortgage. Did you realize that? 9 out of 10 people you know will never pay this thing off. Will never pay off a mortgage. Do you know what the main culprit is in not paying it off? Who can guess? What's the main culprit behind staying in debt until you die if you have a mortgage?
Would it be refinancing?
It would be refinancing. Can I listen? Can I give you a little scenario? I'm going to tell you a little story. All right, I'm going to tell you a little story. Hey, I got Sharice on the stage. Sharice, what do you have for us this morning?
No, I was just going to answer the question about the refinancing part.
Yes. All right. So listen, folks. Sharice, thank you for being here. I appreciate you. All right.
I want to say thank you to you, Don, for sharing such valuable information. I don't think that people really understand the depth of information that that you're sharing with us. It's mind blowing. So thank you. I'm glad I'm a client.
Well, listen, thank you for being a client. We have, and you have a unique situation where you were telling us about a prepayment situation, prepayment penalties, and we're actually going to go over that today. All right. So
that would be great. I'm trying to get that guy on the line with you on the phone.
Exactly. So, ladies and gentlemen, when we are talking about these things, it is so important to know the numbers. All right. Somebody else is saying mind blowing. It's mind blowing. Ice is on fire. Ooh, I love that. Ice being on fire. I absolutely love that. So here is the thing that you all want to know. If you are a realtor, if you are in the mortgage industry, even if you have friends that have a mortgage, and 9 out of 10 people will never pay it off. Okay. And here's why. And I'm going to tell you how you can avoid all of this in just a minute. But here's what's going on. You have a young couple getting together. They have no children. And they start out in their starter home with their 30-year mortgage. All right. And then by the time, okay, now they're about 5 to 7 years in, okay, they have 1.5 children. How do you have 1.5 children? Meaning that they have one child and one on the way. When they have one on the way and they've been in this loan for about 5 to 7 years, they're making more money, and they realize their house is too small because now they have another child on the way. So what do they start doing? They start shopping for another house. They're already 5 to 7 years in. And then they refinance and get a brand new what? When they purchase a new home, they get a brand new what? 30-year loan. A brand new 30-year loan. And they may be 7 years in already. So now it's going to take them 37 years to pay off a mortgage. Correct? All right. That's what Khalil Rashid says. Now they're looking for another house. Of course they're looking for another house. And now 5 to 7 years after that. Okay. So now they have these two kids. 5 to 7 years after that, guess what? Interest rates drop. When the interest rates fall, what are they going to do?
Refinance.
They're going to refinance. And now they're 14 years in, and most people who refinance get a brand new 30-year loan just so that they get a smaller payment. So now they have 14 years in on this thing, and they just got a new 30-year loan. Now they're up to 44 years. 44 years. Now that they're still in debt, right? Now they're still in debt. But now maybe, just maybe, they may be in a situation 5 to 7 years later, little Johnny and little Rebecca getting ready to go to college. And they just didn't save enough money for the college. So now they're about 21 years in to about 20 years into the mortgage. And then they refinance again so they can take money out of their equity to pay for college. What? They've already refinanced. Now, listen, you tell me if this is not the story. You tell me if this is not the story. So now they're in this thing, all right? They got a brand new 30-year mortgage. They're already about 20 years in. It's going to now take them 50 years to pay the thing off. Lord have mercy. Okay? Started at 20. Now they're at 40. Okay? Now they're at 40. Maybe 45. Okay? And now, little Johnny, little Rebecca finally graduate from school. They move out of the house. And now mom and dad are in this big old house all by themselves. And what happens when the kids move out and mom and dad are in this 2-story house all by themselves? What do?
Downsize.
And now they downsize. All right. They're another 7 years in. Okay. And they downsize to a new 30-year loan. Now they're the total of 60 years in, and they'll never pay it off. They just gotta they're at right now about 52 years old, and they just get a new 30-year loan. They're going to be in their 80s if they live that long to pay it off. Most people will die with it. Is that a credible story, ladies?
Yeah.
So let's not do that. Let's learn how to pay these things off in 5 to 7 years with a program that is designed for you to get your equity 5 to 7 times faster. All right. And pay a lot less interest. You want to go to ice10k.com, ice10k.com, and click the link that says get a savings and earnings report. Get a savings and earnings report. Get that report. You will know the month, day, and year you could be debt free. For yourself, for your clients, if you are in the mortgage industry anywhere, as a real estate agent, a mortgage professional, and you share this with your clients, it'll be the best thing since sliced bread for them. When they pay off their house in 7 years, what are they most likely to do in 7 years if they pay it off in 7? Ladies, what are they most likely to do?
Maybe invest in another, I don't know.
Mm-hmm.
With the money that they're saving?
Well, no, just if they pay off a house, what are they most likely to do?
Buy another.
Buy another house. And who are they going to go to?
They definitely going to go back to the realtor.
Mm-hmm.
And my realtor is at the bottom. She just joined. Hi, Melissa.
Okay. They're actually going to go back to listen, how many realtors get to see their clients come back and say, I paid off this house. Now I want to buy another house. And the house that they're in, guess what they do to the house that they paid off? They're going to get a bigger, better house. Okay. And then the house that just paid off, what do they generally do with that? Do they sell it or they turn it into a rental?
Rent it out.
They rent it out.
To cause income.
And then that new income is going to help them to pay for their what?
New mortgage.
Come on now.
Faster. Do it again.
And do it again and pay this one off in 5 years. Oh my gosh. I can't help myself. I cannot help myself. How to pay this thing off. All right. Listen, you need to know the basics here. And now let's take a look at this. And once you get your savings and earnings report, guess what's going to happen? You fill out the information. You can know the month, day, and year you're going to be debt free and how much interest you're going to save. Don, how much does a program cost? It doesn't matter because it won't cost you anything. It's going to cost the bank. If I can save the average client about $150,000 to $200,000 in interest they will not pay, listen, they signed up gladly on this loan here. This is what's crazy. On a $400,000 loan, you're going to pay back $463,000 in interest. That is 115.838% of what they borrowed. 115% more than what they borrowed, they're going to pay in interest, and they gladly signed up for that. If I can cut that by 75 to 80%, that means that's interest they don't have to pay. I get a small percentage of the interest they're no longer paying. So it actually costs the home buyer nothing to work with us because I'm using interest money that would have gone to the bank. Lord have mercy.
Don, I tried clicking on your link. I think the K is missing. Can you update that for me? It says ice10.com and it didn't open.
Hold on.
I'm trying to get the savings report.
Okay, hold on. Let me see here because I probably did it wrong. I did. Listen, I'm typing too fast. Hold on. Let me fix it. All right, go to the link, edit link. Let me edit it. Thank you for pointing that out. ice10k.com. There we go. All right, it's working now. I am so sorry. Okay. ice10k.com. All right. And then when you go there, you'll be able to see that is my video card. You'll be able to see the button that says get a savings and earnings report right in the middle of the page. Now, when you're getting the report, when you're putting your information in, we need to verify your cell phone number. When we verify your cell phone number, make sure there's no spaces. We supplied the +1 already. When you put your number in, make sure there's no spaces between the 1 and the first digit of your phone number. Okay, no spaces at all. And then everything will work correctly. All right. Once you get the code we're going to send you as a text message, take that code, put it back into the website, click on verify the code, and then click on I want to save now. Yes, I want to save. Okay. Yes, I want to save, and it'll let you into the financial form. Put all of your information in that we ask you for. Only takes a few minutes. And then you can know the month, day, and year you could be debt free and how much interest you could save. Wow. What if you're what if you're a realtor and you can say, if you work with me, I'll show you how to pay off this house in 5 to 7 years without refinancing and without changing your budget and without sacrificing lifestyle. And we can, and listen, we could do an analysis like this even before they close. Would you be a hero or a shero to your clients if you could show them how to do this? And how does that benefit you? It benefits you in several different ways. Number one, they're going to love you and then they're going to refer you. Number two, if you click on become an affiliate from the same card and then you refer them to me and they become a client, I'll pay you anywhere from $300 to $3,000 a month. Yeah, from $300 to $3,000 a month referring clients to us, and we do all the work. You do no sales. All you do is refer. We're going to show you how to do all of that. This is what's exciting. Now, I also have a book that's out that helps people to understand all of these things. The book is called The P.I.L.L Method, A Better Way to Eliminate Debt. And it's the only book on Amazon that talks about this subject. And you want to get that book today. Get the book today. Let's get back into it, ladies. Let's get back into it. Now, we've seen what could happen. We've seen what could happen if we prepay. Let me show you what's going on. Let me show you what's going on if you prepay and what hasn't been known in the past. We know that there may be prepayment penalties, especially on commercial property. But we know there may be a penalty, but what we haven't been taught is what is our benefit for prepaying. We don't know what the benefit is. Okay. So if we already know in this situation for putting $100,000 down on this loan, I'm scrolling back down. We're going to put it back on the screen. All right. Kurt is showing my book. Thank you very much, sir. And people are probably buying the book right about now, but that's okay. All right. We put $100,000 down. We're saving $290,000 in interest. So if they're going to charge me a certain percentage for because there is a prepayment penalty, I can guarantee you that the penalty is much smaller than the $290,000 you just saved in interest. I guarantee it. The reason, somebody wants to say, what's the name of the book? It is The P.I.L.L Method, A Better Way to Eliminate Debt. The P.I.L.L Method, a better way, a better way to eliminate debt. And there is a link on my 10K card, ice10k.com. There's a link that would take you directly to the book, right? A better way, the P.I.L.L Method, A Better Way to Eliminate Debt. Now, here's what we need to focus on. If you call up your lender and you tell them, I want to prepay a certain amount of money, they will have to tell you what the penalty would be to do that. What they don't tell you is how much interest you would save to do that. And that's what's left out of the equation. Ladies, does that make sense to you?
Don't ask, don't tell.
Come on. That's what's happening. So we're not thinking about, because we've never been taught how to say, but listen, if you're a realtor right now in this room, to get your license to be a realtor, were you ever taught how an amortization schedule actually works and how you can beat it? Was that part of your training, how a loan actually works? Anybody? Because I've been asking this question for 17 years. I get the same answer. No, we haven't been taught. If you're a loan officer, have you been taught how a loan actually works? The answer, again, is still no. They haven't been taught either. So all of this stuff in the news, is a distraction from what is really going on, how much money banking is making on these loans. My goodness. How much money banking is making on these loans. That's what we are conditioned not to see, but we also need to see through some education how much interest we could actually save. So let me put some examples on the screen of how much you can save. Cherise, did you have something?
Yeah, I just wanted to ask a quick question. So, in my case, where I'm trying to save from where I live at, the officer kind of laughed when we asked about it. And he said, oh, that prepayment penalty would be X amount. Like, it was a ridiculous number. So how do we get past that?
Oh, well, they laugh because they don't know how much interest you'll be saving, you see.
The number he said was ridiculous. So I don't know if he just threw out a number. He's like, oh, you times the loan by whatever the percentage rate is today. And I'm like, that's not the formula.
And here's the thing. What he was talking about is if you decide to pay off the entire loan today. So what we want to go back and ask them is, if I prepay $50,000, or if I prepay $75,000, or if I prepay $25,000, what will my penalty be if I prepay that? You see, not paying off the entire loan. Because see, listen, when you take a look at that building, and what he said was, even if the amount is super high, it doesn't come anywhere close to the amount of interest you would have to pay to make every single payment on your building. Okay?
Right.
You owe millions of dollars in interest on your building. So when you look at how much interest I'm saving, and then you subtract out of that how much the penalty would be. Let me give you an example of a situation in Canada I had. Because in Canada, they have prepayment penalties on residential properties. and it's quite common. They even have it right on your mortgage website, how to calculate your prepayment penalty. Yeah. So when I told my clients that they could save $100,000 in interest with this move that we're getting ready to do on their mortgage, they were worried about the prepayment penalty. So we went to their site and put in all the numbers. What they were armed with was how much interest they would save. And this is information most people do not have. So they're going to save $100,000. When we put the numbers in, do you know what their penalty was going to be? $1,200, $1,200 to save $100,000 in interest. You see, when I only look at the penalty, all I do is avoid. You have to do all of the math involved, find out what your benefit is, and then take a look at the cost. You find out that there is no cost. And that's the way it is with every single prepayment penalty I've ever seen. The cost to prepay is much less than the interest you would have paid if you just made every payment to avoid the penalty. That's what
How about not even that it's much less, it's significantly less.
Significantly less. My goodness. I make that trade all day. And that's what we need to do when you have a company that's on your side that can do the math, that can look at the variables that are being left out of the equation and insert those variables so that you can see that, listen, we are with you for a lifetime, Let me show you some of the clients we're working with here, okay? Let me just show you some of the clients that we're working with on some of these things. Here is a real estate investor, all right? A real estate investor that has a $200,000 mortgage. It is a multifamily, and they're paying 18% interest. 18% interest. Are you kidding me? Yeah, 18% interest, because it doesn't matter. They're making $6,000 a month on this property. Even at 18%, their payment is $3,014.18. So answer me this, ladies. If I'm making $6,000 on my property, but my mortgage payment is $3,014.18, do I really care? Do I really care if I'm cash flowing nearly $3,000 a month on this property? Isn't that something? So we're going to show this person how they can take this loan, pay it off in 7.8 years, save $712,000 in interest, take that money that they would have paid in interest and turn it into $1,190,000. This is the kind of thing that we do. So not only do we save you interest, the money that you would have paid if you had made every payment, we're going to show you how much interest you're going to save. And it says, listen, if I was going to give it to the bank, let me now take that same interest money and invest it in other doors or in other properties and turn it into big money for myself. Now, this $1,190,000, that's only at 1% return on the. I need you to see this. This is your savings with a 1% return. Imagine your savings at higher rates. Man, we have clients working with us that are making anywhere from 7 to 14% on their money. 7 to 14%. But when we talk to them, when we give them this this analysis, we're showing them what would happen if they only made 1%. Magic. Listen, this is good stuff. This is good stuff. Keep inviting people in. And join the house. Listen, go up to the P.I.L.L Method link up top. Click on that P.I.L.L Method link, and you will be able to see that you can join this house and get this kind of information that will be coming out to you forever. Because we're on YouTube, we're on Facebook, we're on Twitter, we're on LinkedIn, and we're on Clubhouse, and all of this. You can have the replays. You could be on the replay. So let me show you another one. Let me show you another one that here's one. Here's a client that has, it's only $156,000. Only $156,000. But look at this. The interest rate is 4%. The interest rate is 4%. How much interest does the bank want on $156,000 at 4%? $112,447.46. Does anybody want to pay? Listen, that's a whole nother house. Who wants to buy one house for themselves and another house for the bank? Anybody? Put it in the chat. Oh man, this is what Sheila Coleman says from, she's put a comment here, and she's watching us on YouTube right now. So Don, most people are concerned about the monthly payment. That's correct. So the example about paying $100K on with your first payment, which cuts you 164 payments. It cuts off 164 payments. What do you say? Hopefully the question is clear. Yeah. So here's what I say. Here's what I say. If you can afford the payment, then here's what I did for my client. When they put their $100,000 down, it cuts a bunch of years off. Okay. It cut about 12, 13 years off. Okay. And then what they did was put their whole program, their whole mortgage into our program. So when they put the $100,000 down, that cut 164 payments off. They only had a few years left. Okay. By using that $100,000 that way, but we saved them even more money. By using the P.I.L.L method interest cancellation system, they paid off the entire thing in about 6 years. The total interest cost, $30,000. $30,000. That's it. When the bank wanted a whole lot more. So Sheila, I hope I understand your question. What do I tell people all the time? I tell them, these are payments you don't have to make. If you do it the bank's way, you will make all of these payments and more. Stop doing it their way. Learn a better way, a different way to look at these loans. Because we have not been taught, this information is not taught in schools. It's not taught at any level of financial education. Nowhere. If you're a CPA, you will not get this. If you're a financial planner, you won't get how a loan actually works. If you are a real estate agent, if you're a loan officer, you're not getting the information you need on how the bank makes their money through these loans. That's the information that's being left out of our education. How did we get this far when the most ubiquitous financial tool on the planet is the interest-bearing loan? And no one is teaching about it, except here, the P.I.L.L method, except right here. This is why I need your help to share this information. So listen, you want to continue to help sharing this information on how somebody, instead of paying $112,000 in interest, we're going to show them how to pay $22,000 in interest instead. Okay. $22,000 in interest instead. What is going on with shoot, what's going on with this? Let me get this off of here. I can't get this off. I clicked something and it wasn't working right. All right, so I can't get that off my screen. Wait a minute, folks. Thank you. All right, so listen, if you want to know more about what we're doing and you want to share this information, go to ice10k.com. Go to ice10k.com right now and click the link that says become an affiliate. It's free to sign up and start sharing this information with other people. All you have to do is guide them to our YouTube channel, let them watch a few videos, and then follow up with them in a couple of days. If they have at least $100,000 in debt and a mortgage, and you send them to us by clicking on the other link that's in this card and filling out the referral form. You fill it out. You fill out the referral form if they've watched some of the videos and they're still interested. All right. Then what you do is hold on for a second. Yeah. What you do at that point is fill out the other card, the referral point, and put your name and number in as the referring partner. And then we'll give you a referral fee once they become a client. You can't beat it. You can't beat it. Okay. Thanks, Don. I really enjoyed your sessions. I will be following up with you. I have to go for now. Well, thank you for being here. You have a wonderful day as well. Thank you for being here. I appreciate you. All right. I appreciate you. All right, folks, this is what we're doing. We want to make sure people get the information. And now we're bringing on all kinds of partners that you're getting this information and you want to be blessed for sharing the information. So this is how the referral system works. Send us one referral in a month and they become a client. We will pay you $300 for that referral. Send us a second one in the same month. We'll pay you $400 for that one. Send us a third one in a month. We'll pay you $500 for that one. Send us a fourth one. That one is worth $600 in the same month. But if you send us a fifth one in the same month, we'll pay you $1,200 for that one for a total of $3,000. Yeah. So if you want to become, if you like this information and you believe it's worthy, that there may be people out there that are looking for a better way to deal with their debt, sign up to become an affiliate. It takes 15 seconds and it costs you nothing. All right. But if you have debt, you'd actually want to become a client as well. You actually want to become a client as well. Sharice, are you still with us? I don't know if she is or not. Okay. Sharice going once. Sharice going twice. She's probably doing something, probably working. All right. Anyway.
Yes, I'm here.
Good. So you said that you said you were a client. What benefits, if any, have you seen for being a Pill Method client?
I mean, just reorganizing all of my debt. Actually, the program actually helps you really get a really good look at, what you're spending. Yeah, it's scary sometimes. But it's definitely a plus. And just, to know that I would be able to pay off the mortgages within the 5 to 7 year period is just phenomenal.
I absolutely love that. Thank you for being here. And have you had an opportunity to interface with our customer service team?
Yes, I have. I still need to call them back. They're very, very helpful. Yeah.
Okay. Have you ever called customer service during business hours and received a recording?
Yes.
And received a recording?
Oh, no, I don't think I received a recording.
There you go.
No.
Somebody always answers our phone, right?
Yes.
Okay. So, folks, we're going to be there to not only supply lifetime customer service, but we also give you coaching along the way so that we can improve the response of the program. Because most people who get an analysis from us, we're going to tell them the month, day, and year they're going to be debt free. But once they actually put their information into the program and work with a coach, we're going to improve those numbers usually by 10 to 17% within the first week. Boom, just like that. By working with a coach, we're going to tweak your program so that you don't have to learn all the ins and outs in the first week. We're going to work with you. We're going to supply you a coach that's going to continually to work with you for the first few months you're in our program. along with client support. So you're going to have two levels of support. One is a regular appointment with your coach, and the other is anytime you want to call client support and ask a question. We're going to support you the entire way. Plus, we're going to give you a lifetime guarantee on this program. What does that mean? Lifetime guarantee. Well, if we're going to be paying off a mortgage in 7 years, why do I need a lifetime guarantee? Because we're going to guarantee the second house on the same program, and the third one, and the fourth one, and the fifth one. We're going to guarantee it all. Even if you've paid off 5 houses on our program and the program starts to go haywire and we can't fix it, you can use your lifetime guarantee and get all of your money back. The program must always work. Okay? How much does it become? How much does it cost to become how much is it to become a client? Okay, how much is it to become a client? It all depends on the work that we do for you. Okay? Now, I had a guy come over to my house yesterday to take a look at my deck. We need to replace some boards and stuff. And so I'm asking, how much does it cost? I asked him, how much do you think it would cost to repair my deck? You know what he told me? He says, Don, I have to come over and take a look at your deck. I don't know what else you needed. And guess what else I found out? Not only do I have some deck boards that need to be replaced, he found a beam that was rotting that supports the deck, which is about 30 feet long, that needs to be replaced. Oh, well, was there any way he was going to be able to give me an estimate on fixing that over the phone without coming over and taking a look at it and finding that beam that also needed to be replaced? See, folks, people ask that a lot. It's not one price fits all. We're doing specific work for you. We need to do an analysis, and that analysis will tell us how much we are saving you and what kind of work we have to do for you. So if I'm saving a client $250,000 and we get a small percentage of the interest saved, you're not actually paying us anyway. It's money that would have gone to the bank. So let me show you how to make your bank pay for it. And you don't have to worry about it. Okay? Let's show you how to make your bank pay for this lifetime program. All right? Because aren't we paying them enough money already? Please, let's let the bank pay for something. I absolutely love that. So, folks, listen, we started this show at 7 a.m. Central Time. It is now 8:19. I want to know if there are any questions on the stage. Do you have any questions in this room? Raise your hand. Come on up. Oral says, come on up. I'm sorry. Invite to speak. All right. We're going to bring Oral up. Anybody else that wants to raise their hand and come up and ask a question. All right. I'm inviting people up right now. So invite to speak. Anybody else? Raise your hand. Steve wants to come on up. All right. Bring them up. Anybody else? Raise your hand. Come on up if you have a question or a comment. Steve, I see you on stage, man. Talk to us. You're here on Clubhouse. Talk to us this morning. What's up?
Oh, nothing. Just came up to populate the room. Phenomenal conversation, and just intrigued by everything. I'm just listening.
Listen, man. This thing about with people with people with good credit, are they actually going to cost you more to purchase a house? We're showing today that what they're doing is distracting us with information that is not important to our bottom line. How much is it going to cost us to borrow money? The bank has been expert in getting us to ignore what is the total cost of borrowing money. It is a tremendous amount of money. The total cost. So all of this whole article that I have on the screen right now, we got that article back up on the screen. I fixed my program, Kurt. We got this whole thing, $400,000. Okay. We're going to put something down. And so is it going to cost us $8,200 to do it or $4,500 to do it? I'm going to put that money down. They're assuming if you have it available, you want to make a down payment. That's what they're assuming. Everybody is assuming that. P.I.L.L method is saying never put any more down than you have to. Sometimes, if your payment requires it, if your payment is just too high for your budget, and by putting some money down will lower that payment, only put enough down to get the payment where you need it to be, then hold back the rest so that you can put it down strategically as prepayments to save you interest and to save you time. Let me read this part of the article that says, is this a good thing? It depends on who you ask. Don't ask the P.I.L.L method. Don't ask the P.I.L.L method because we'll tell you the truth. It depends on who you ask. Critics say the new rules penalize people with good credit, using them to subsidize loans of riskier borrowers. It's another subsidy to try to buy votes. Okay. Former Home Depot CEO. All right. Says that the new mortgage fee rules do nothing to address ongoing inventory challenges, which is true, in the housing market, which is putting upward pressure on home prices. The median U.S. home price in March was $400,528, according to realty broker Redfin. So, if the average house, if the median home price is $400,000, you can't do anything about that. You're going to negotiate the price of your house. But once it's negotiated, there's absolutely nothing you can do about that. Nothing. But here's what you can do something about. Here's what you can do something about. The amount of interest you pay on this thing. Because when you take a look at it, when you purchased this house for $400,000, you made your best deal available. You made your best deal going. All right. But you're not paying $400,000 for a $400,000 house. The bank wants you to pay, and 9 out of 10 people will pay this and more. They want you to pay $863,352 for your $400,000 house. Because when you add the interest into it, then that is the real cost. That is the true cost of your home. When you add in what you negotiated as the price and when you add in the cost of borrowing the money. Once you have negotiated the price and you paid for it, you can't do anything about that. But what you can do is cut this interest cost by about 75 to 80%. You do not have to pay them $463,000. You can pay them a lot less. Okay. Now, in the last few minutes here, does anybody want to know the basics of how interest cancellation works? If you do, I'll put it on the screen. I'll show you some of the basics. All right. The basics of how interest cancellation works. If you want to know, put a number 9 in the chat. Put a number 9 in the chat or on you. If you're watching us online, put it in the comment section. I will show you the basics. All right. In the last few minutes here. And I'm getting some 9s. All right. All right. I'm getting some 9s. So on this $400,000 loan at 6%, oh, here they come. All right. Let me show you some basics, something you can do even without my program. All right. But keep this in mind. My program is designed to save you the maximum amount of interest you can save per dollar. The maximum amount of interest you can save per dollar. But I'm going to show you the foundation on which our program is built. Here's the foundation. Knowing prepayment of principal. The P.I.L.L method stands for prepayment of principal, isolating the principal amount, leverage, and liquidity. Here's what's going on. When you make your very first payment on this mortgage, $398.20 goes to principal. And if you're new to the room and you want to see this, hi Berna, I see you in here. If you want to see what's going on, go to YouTube right now on a secondary device. You could another phone, your laptop, your tablet. Go there, search for P.I.L.L method, all right, and join the live feed so you can see these numbers. Listen to us on Clubhouse, watch the live feed. All right. So on this very first payment, look, this is pitiful. $398.20 goes to principal. Look how much goes to interest. $2,000. $2,000. The next month, $400.19 goes to principal. And the next month after that, then this month, you're paying $1,998.01. The payment stays the same, but the configuration of how much goes to principal and interest changes each month. You pay a little more principal and a little less interest each month until it's paid off. That's what amortizing does. Gives you a payment you can afford, but it is that one payment is so expensive. What do you mean, Don, that the payment is so expensive? Let me put a calculator on the screen. Here's why it's so expensive. Your total payment is $2398.20. But your first interest payment is $2,000. Divide that by your total payment of $2398.2 equals 83.3. That means 83% of your payment is interest. 83% of your payment is interest, or 83 cents out of every dollar you're paying towards this mortgage goes to the bank. And you're buying your home with 17 cents out of every payment dollar. Who wants to do that? I'm buying my house with 17 cents out of every dollar I'm putting towards it, but the bank is getting 83 cents out of every dollar I'm putting towards my mortgage. Crazy. Stop it. Here's how we can stop it. We can actually save money at the same rate they're charging us. Let's say we make this first payment in January. $398.20 goes to principal, $2,000 goes to interest in the first month. I can see, if I have this amortization schedule in front of me, I can see February's principal payment. Here's my question to everybody. All right, I need you to put it in the chat. If I can see February's principal payment of $400, do I have to wait till February to give that money to the bank? I just made my January payment. I'm all done. But do I have to wait till February to give the bank an additional $400.19? Yes or no? Do I have to wait? Yes or no? Put it in the chat. Okay? Or open up your mic if you're on stage and just tell me. All right? All right, everybody's saying no.
No, you don't have to wait.
All right, okay, I don't have to wait. So what if I had it in the bank? If I had it, could I give that to the bank in January as well? The answer is yes. I'm going to give the bank $400.19, give it to them in January, and guess what? All of this money goes to principal. Every last dime of it goes to principal. I'm paid down to line 2 on my amortization schedule in just the first month. I made my regular payment, plus I gave them the $400.19 from line 2, which immediately knocks out line 2. My next mortgage payment is based on the number on line 2, not the one on line 1. So my next mortgage payment is actually on line 3 of my schedule. I just got rid of line 2 for just $400.19. And what happened to this interest payment on line 2 of $1,998.01? I just saved it. I just canceled it. I never have to pay that. Your overall interest cost has been reduced by nearly $2,000 just by giving the bank $400.19 early. This is what's not being taught. We can teach this in 8th grade. If you knew this in 8th grade, how a loan works, you guys would be killing your loans right about now. All of them, whether it's a car loan, a mortgage, student loans, all of that. If you knew what really happened to prepay. I was teaching this to 8th graders in Houston. They absolutely love it. Anytime I talk to students, they get it because they have not started really paying mortgages or other loans the way that the bank is teaching them. I'm teaching them ahead of time. You don't have to do that. and they soak it up like a sponge. The ones that don't soak it up really well are those who have been conditioned to give the bank all of their money. Do you know I have, Lord have mercy, help us. I have seasoned investors that argue that they're better off paying all the interest that the bank wants because they can do something else with their money and invest it. They're not getting that 80% of the money that their tenants are giving them is going up in smoke. They're not getting it because they're so used to doing it this way. They have to see it over and over and over again until it finally clicks. You know what? I can still invest and save money and interest. That's where we have to get them. Okay. So here's what's happening. If you do this, you make your first payment. What if you pay your first payment on this and take a look at the next 3 principal payments? The $400.19, the $402.19, and the $404.20. What if you give the bank a little over $1,200 on top of your regular mortgage payment? Do you see? You knock out nearly $6,000 in interest you never have to pay. I prepay about $1,200. I can get rid of almost $6,000 in interest I don't have to pay. That's how it works, folks. That's how it works. Look at line 12. I need you to take a look at line 12 on here. Anybody who has, I'm looking to see if I have any other hands raised so they can come to the stage. Watch this. And cumulative principal, all right? On the first year on this, I'll pay this loan down by $49,1202. The bank wants $23,000 in interest, almost $24,000. Isn't that ridiculous? How in the world are we ever going to get? Listen, you know what I tell the students when I go talk to them? Your parents are spending your inheritance on interest. That's what I tell them. You know, I got some feedback the last time I went to Houston and started talking to these students. One of the students went home because I gave the students my book. I gave them, all the students, an autographed copy. All right. I went all around the school. I think I talked to 6 or 7 classes that day in the school. And I gave them my book and signed it. And one of the students came back after and reported to their teacher. I told my parents that you're spending my inheritance on interest. The parents didn't like that very much. But watch this, folks. Watch this. If we pay this loan down by $4,900 in 1 year, here's my next question. Do I have to give it to them in 12 monthly installments? Do I have to pay them the $49.12 in 12 monthly installments? Or if I had it, could I give the bank the $49.12 all at one time? Could I give it all at one time, like on month 1 if I had it? Guess what happens when you do? You skip all the interest payments between line 2 and line 12. Okay? And you save $21,000 in interest you never have to pay, almost $22,000 in interest. The only interest you'll pay is the $2,000 on line 1, two grand. Make your regular mortgage payment and put the $49,1202 on top. Boom, you save a ton of interest. That's what we're doing. But our program tells us how much money to move. So we're breaking it down like this. We're taking a look at your entire budget. On, what's today, Wednesday? On Friday, when we dig into this a little deeper, on Friday, we're going to dig a little deeper. And we're going to spend a whole show on the opportunity cost calculator. The whole show on Friday is on the AI system and the coaching. Okay? How AI can save you tons of interest. That's what we're going to be talking about on Friday. Okay? AI and coaching. True financial education. We're going to show you how the computer system is showing us exactly what to do, what month to move money in, what day of the month, which loan to attack, to make sure you can save more money per dollar. Right now, we're paying over 80 cents out of every dollar going to this mortgage. Over 80 cents out of every dollar is going to interest. Crazy. And only about 17 cents out of every dollar is going to pay down the loan. What if you bought groceries that way? I did this the other day. What if you bought groceries the same way, where 17 cents out of every grocery dollar was just buying groceries and 80 cents went up in smoke to interest? Here's to buy $200 worth of groceries. Here's how many dollars you would have to give your grocery store to buy $200 worth of groceries if only 17 cents bought groceries and 83 cents went to interest. Put your $200 in and divide it by 17 cents. Divided by 0.17. It would take $1,176 to buy $200 worth of groceries. Ladies and gentlemen of the jury, do you want to pay $1,176 of your hard-earned money to buy $200 worth of groceries? Do you want to buy your groceries this way?
I'll be fasting.
Do you hear me? Did you hear that? She'll be fasting. Listen, folks, we would be outraged if we were buying groceries and 80% of our money went somewhere else instead of buying the groceries. What if we went to a grocery tax? 83 cents out of every dollar goes to grocery tax. All right. Listen, you're already paying tax on gasoline. What if it costs $45 to fill up your tank? $45 worth of gas to fill up your tank. What if there was a tax on gas where 83 cents out of every dollar you put towards here, and you wanted to fill up your tank? We're going to divide that by 17 cents. So we're going to divide that $45 by 17 cents. It would take $264.70 to fill up your gas tank if only 17 cents out of every dollar was going to purchase gas and the rest went to gas tax. We would be outraged. We'd be picketing. We'd be marching up and down the street. We would say, we'll never pay that kind of money for gas or for food. But we do it routinely because we have been conditioned to pay this for our houses, our commercial buildings. We've been conditioned to do this. And even with this thing that the government is trying to do, it is still a distraction for what really could happen in our lives. Ladies and gentlemen, I want to thank you for being here today. We're getting ready to get out of here. Do not forget to click on the link above. Go to ice10k.com. Watch the video there, because I'm getting ready to play the video that's on there. Watch the video. Also, get your savings and earnings report. Don't forget that. Get my book. Don't forget that. Okay? And don't forget to become an affiliate. It takes 15 seconds to become an affiliate and share this information with others. All right? Share the information with others. And I want to thank everybody for being here. We're going to be right back here on Friday. All right? Oh. I'm going to do a nighttime show today. All right? On Clubhouse. I'm doing our first nighttime show on Clubhouse today at 6 o'clock, I believe. I believe it's at 6 Central Time. So tune into that on Clubhouse. We're going to be talking about, let me pull that up. What are we going to be talking about tonight? I forgot let me go here. What you do is just click on my profile and then scroll down to where you could see our house. Okay. And click on where it says the P.I.L.L Method House. And then take a look at what we're going to be talking about tonight. Debt-free in 7 years or 0% mortgage. What? 0% mortgage? Oh, you listen, you want to know how, and I'm going to be putting we're going to use Zoom to show you the numbers. If you want to see how you can get a mortgage and virtually pay no interest at all, how would you like to get a mortgage and not pay any interest? Ho, ho, ho. I'm going to show you what a virtual 0% interest looks like and show you how you can pay off everything in 7 years. I'm going to show you that tonight at 6 p.m. Central, and we're going to put the numbers on Zoom. And my our Zoom link is zoomice.com. 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 And that will take you to our Zoom so you can see these numbers. I'll see you tonight for those who are going to be here. But be back here on Friday for our daytime show. And we'll be back on Sunday as well. But thank you for everybody for being here. Don't forget, get the book, become an affiliate, and also get your savings and earnings report, not only for yourself, but for family and friends and clients, and also get paid. I absolutely love it. Any questions, any comments before we do our final goodbye? Any questions, any comments? All right. Well, that's it, folks. Listen, we're going to hear from Dr. Eric Thomas. You know, it was last year this time, all right? Last May, Dr. Eric Thomas spoke for us. I did a seminar in Nashville, Tennessee last year. Dr. Eric Thomas came in, who was our keynote speaker, and he talked about the stress his wife was feeling because they still had a mortgage. I want you to know that he used the concepts from the P.I.L.L method to pay off his mortgage in record time. Let's hear what his wife had to say, and then that will be it for today. He's going to have the last word, and then we're going to go straight into our outro music, and I'll see you guys again on Friday. Have a good day, everybody. Thank you for being here. Dr. Eric Thomas, take it away.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down from my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.